Hello, everybody. Good afternoon. Thank you for joining us. I'd like to sort of run through the structure of what we're going to do. I will do the introduction, of course, and outline the progress of the company in the last financial year up until mid-March. And then we'll talk about the effects of COVID and the lockdown from March onwards, which seemed like 6 months, but it was actually only 2 weeks to the end of the financial year. And then we'll do the financial summary with Paul Forster, our Group Finance and Commercial Director, and then marketing and sales summary and key results with Pippa, our Group Sales and Marketing Director and Deputy MD. And I will then finalize it with future targets and aspirations. So starting off with the company progress for the last financial year up to mid-March, progress was very steady right until the lockdown. Sales were projecting at around 10%, not quite up to the previous year, but doing very well. We were winning new business with key customers, winning new customers and benefiting from the purchase of a new brand. Our cash generation was very good. We were heading towards 3 million. We're planning to continue with the dividend, increase capital expenditure on new, faster and more efficient machinery mainly, and acquiring another brand. Everything was going well until mid-March. Factory efficiency was steady. We defined that by the factory bonuses, which are paid weekly and monthly, and they were in line with the previous year. We were continuing with our mantra, quality, service, innovation, planning to reorganize the logistics system and warehousing in preparation for continued expansion, planning sizable capital expenditure, as I said, to facilitate growth. Our average hourly wage was approaching and in fact hitting £10 per hour, which we feel good about. Our target is actually to have the base rate at £10 an hour by 2021 and still maintain our cost effectiveness. We were increasing sales, but the increasing sales were pressurizing the limits of our current facilities. Good thing, but challenging. So the team, old and new, were delivering on all the key targets as they have done over the last number of years. So then we hit mid-March and COVID. Major international retailers canceled orders. Private label sales dived. Orders for standard products dried up. For the 2020 financial year, suddenly we were faced with £1 million of debts, which were at risk through cancellations. £1 million worth of stock and work in progress, again at risk through cancellations. The leading companies were claiming force majeure in these circumstances, and we felt pretty challenged at that particular time. We were required to furlough key workers who were vulnerable. We had increased costs of security, transportation, and social distancing. Key workers who were vulnerable and were ill, we were forced to pay for 14-day isolation. Our workers were extremely nervous, very difficult to settle them down. We were paying £10 a day bonus to all people who attended the factory. And as a result of that, we were able to maintain output, but we had to go out there and recruit quite a number of people in those circumstances. The £10 a day cost us probably 150,000 by the end of June when we were able to terminate it. So on the positive side, we seized the initiative right away to control the infection. 100 key marketing and sales executives were prepared to work from home. Our group finance director, namely Paul, and our group technical director, Martin Stevens, took control of the site and attended every day, probably on a 16-hour day basis. The technical manager stayed on site at Devon and took absolute control. Orders increased massively for hygiene products, so we switched our machinery and our resources to produce that, which took a lot of effort, mainly for the grocery and high street retailers. After a lot of effort, we brought the NHS on board by the end of April. We cleared a long and complicated approval process. The factory switched to making hygiene products within a matter of weeks, and we installed testing systems for our employees, both swab testing and antibody testing, and rigorous control by temperature checking before entry. This reassured staff as well as as keeping us virus free for most of the time. Our testing proved that probably 4% of our workforce have had COVID in some shape or form and are showing antibodies, which is about the national average. Our procurement department worked well in sourcing components and raw materials that were in short supply. Our technical department sourced grain alcohol, which we never used before, in hygiene products, and persuaded the HMRC to allow Creightons to denature that product rather than pay duty on it. Quite a long process. By the end of May, high street retailers who cancelled and left unpaid amounts had returned to take up components and finished goods, which, if we hadn't already repurposed them, a relatively happy ending for the year to March 2020. So I'm now handing over to Paul Forster to give you the detail of the financial results for the year. Thank you, Paul.
Hello. Similar format to previous years, we'll just go through the financial highlights which were published this morning. As you can see, revenue increased by 8.6% compared to the previous year. Our sales in the last few weeks of March were hit by around about 400,000 for orders that were ready to be shipped that customers cancelled or delayed. So there was a small hit on the potential outcome at the end of the year. And we'd already started to incur a little bit of costs associated with COVID-related costs, but relatively minor in the last 2 weeks of the year, probably in the order of sort of £30,000. The operating profit increased by 29% to 3.75 million, largely driven by the operational leverage of the sales growth on the business, and that's also showing through in the operating margin of 7.9% compared to 6.6% the previous year. Fully diluted earnings per share increased relatively modestly, but partly the 2019 figure was artificially high as we had an R&D tax windfall in that year, so the tax charge was very low. In fact, it was negative, which means that the EPS in the comparative year was not truly comparable. And I'll come on to talk a little bit about that later on. After reviewing our results for the year and looking at the potential outcome for the current year, taking into account the switch in the business that Bernard talked around towards the hygiene and related products and the NHS contract, the board came to the conclusion that we could continue on our path of increasing our dividend, and therefore we've proposed an increase to £0.005 per ordinary share as the final dividend. During the year, we acquired a brand. It cost us £500,000 to acquire that, and it contributed £1.2 million worth of sales in the period. It also it fitted well with our portfolio, as we said at the time, of customers, our manufacturing capabilities, and also at that value end of the market was a higher retail position, which gave us a slight boost in operating margin as well. So the brand has been a positive contribution towards the group's performance in the year and likely to be so going forward. During the year, we acquired the Peterborough site. That went through as a shareholder meeting. The total cost, including the stamp duty, etc., was £4 million. That's been capitalised. We put a mortgage on at the same time of 3.04 million from HSBC. So both of those are features of the results, and again have impacts that I'll talk to later on. Cash and cash equivalents increased by 3.3 million. So this is excluding the mortgage. But if we take the mortgage, which was acquired, it shows that the group is capable of generating quite a lot of cash to enable it to grow the business. So moving on to the next slide, just talking about the revenue, you can see a steady progression in revenue there. And the revenue, the 8.6% we talked about, overseas sales, which is a positive thing for the group, grew by 43%. Going to £7 million. And I think people will probably allude to this later on, but a lot of that was a growth around core retailers where we're trading direct with the retailer rather than through distributors, which gives us more control, we feel, over the relationship and the ability to develop those customers. Our retailer-owned brand grew by 29%, and again that was primarily driven by growth with the major retailers in the UK. And our own brand, our own owned brands, grew by 18%, and that includes the contribution from the brand we acquired. The one area that was a negative, and I will mention it, was that the sales in our contract division fell a little bit in the period. Part of that was one major customer who bought its own manufacturing facility and moved the production in-house, which had an impact on the year. But I think this shows this mix and growth, and whatever gives shows the strength we've obviously talked about in the past about the having three different ways of growing the business and targeting customers, whether it's a contract with the customer, servicing private label to retailers, or our own brand. It gives us the flexibility and the ability to respond depending on how the markets turn. So moving on to operating profit, you can see the steady trend in those going up over the years, 29% in the year. The operating profit margins increased to 7.9%. And as I mentioned, a small decrease in profitability, impacting profits, well, a relatively small of the COVID-19. So those figures in the current year would have been even better had we been able to make those deliveries in the last few weeks of the year. Moving on to operating profit margin, I just wanted to show the flow on the operating profit margin. The solid line is what was reported. The dotted line shows the impact if we had not had to outsource products when we met a capacity constraint three years ago now, roughly 2.5, 3 years ago. And I think it just shows that the decision made at that time to outsource, incur additional costs, continue the sales growth, reposition our manufacturing capabilities and bring back in-house was the right decision, albeit it did impact on margins in that particular year. So I think but this slide illustrates our ability to get the operational leverage and the economies of scale that are coming with the continued sales growth in the business and deliver those to shareholders. Diluted earnings per share. Again, I said a little bit earlier, last year's was artificially high because effectively we had 361,000 of R&D tax credit in that year that related to prior years. We had a multiple claim in the year. So taking that out, again, you can see a continued growth in earnings per share for shareholders. Return on capital employed has fallen in the year. The main reasons are that we purchased the site. Therefore, we increased our operating set and funded that with a loan. And also, there was a financial impact of IFRS 16, where we moved assets onto the balance sheet and the liabilities into the long-term loans. The IFRS adjustment was around about 800,000. The biggest element on the long-term borrowings aspect of this equation was the impact of the property loan. So that has artificially depleted, reduced the returns on capital employed, but also our working capital has increased. We've got cash on hand, so the continued growth of the business has, increased the asset base of the business as a whole. And what that does give is opportunities. The strength of the balance sheet, the fact that we had cash on hand and a long-term loan secured on the property, has given us opportunities to respond to growth either through acquisition or through organic growth. And it certainly enabled us to respond to COVID in a positive way, where we've been able to reposition the business, source components very quickly from around the world to bring in and meet the demand that was for the hygiene products that came through from sort of April, May, June onwards. And it gave us the ability to make investments quickly in certain bits of plant and machinery to accommodate the hygiene gels with high alcohol contents that needed, for example, 80% alcohol content for the NHS business. So it enabled the business to take advantage of the opportunities that COVID presented us, and we certainly have done that. Just a quick overlook at the net cash position. I left this slide in. We do it every year. The actual total borrowings of the group are now 1.03 million at the end of the period. But of that, 3 million is the long-term loan on the property. If I exclude that, you can see that the group was sitting with a net cash position of 1.95, and as I mentioned, sort of 3 million pounds of working capital available to the group. So that working cash position is after buying the site and the group's contribution net of loan of £1 million, but also the brand we acquired in the year. So I think it's shown a positive position of the group and the future. Just finally close off on, well, not finally, but look at the working capital. The cash and equivalents increased by 3.3 million. The stock turn, although the overall stock went up, the turn based on the order book went down. So we've improved our stock turn. Debtor days went up a little bit. About 1 day of that was related to the mix of customers and the longer term, and a little bit was a tiny bit was customers had not paid in the period. But frankly, as Bernard mentioned, we had a bigger hit on customers delaying payment after the year end than in these figures. And I think that if we had kept to our original timetable, we'd have been in a position of possibly making harder provisions than we needed to in the circumstances. And delaying the results has allowed us to work through with the customers. I think it's important to note that we helped customers through this with deferred payment, and that we didn't lose a single customer and haven't lost any. There hasn't been any bad debts as a result of the COVID situations. And I think an important point to make is that since then we took a more assertive stance in terms of credit control, where in the past certain blue chip customers we've chosen not to credit insure. We've now credit insured every single customer, or they pay in front, except for the Department of Health and Social Care, which I hope is secure. So it's a positive position going forward, and even with the cancelled orders, as Bernard mentioned, we were potentially looking at a big liability with cancelled and deferred orders. But almost every one of those customers have now started trading again, replaced orders, or now taking the product that they cancelled later on in the year. So overall, the business has managed to weather that initial storm of the close down. I would think better than most, but we'll take that. I thought, just to round up, just look way back in June 2017, we set our aspirations, and I just think it's useful to benchmark ourselves against ourselves. We said we'd go for a turnover of 60 million. We've got to 48 million. We'll wait and see what March next year delivers. Net profit of 5% after tax, well, we're delivering on that. A dividend, we've not quite got there on the 2%, but that's because the share price keeps going up. But we are continuing to increase our dividend. Our return on capital employed, we set a target of up 20%. We're still at that, but we've got lots of opportunities to be able to grow that return on capital employed as we utilise the cash. And I think the well-balanced team, I think I'd like to think what we've done in the years to date, and what we've done and how we've responded to COVID illustrates that we are agile and flexible and willing to take advantage of the opportunities as they arrive. Okay, that's finished from me. So now I'll hand over to Pippa, and she can take you through the sales and marketing aspect.
Thank you, Paul. Good afternoon, everybody. So in the context of Bernard's introduction and Paul's explanation of the financial results, I'm going to give you a top line on the market, what we're doing in that market by division, and a bit of an insight as to how we're performing in each of those divisions. In terms of the UK market, just to give you some context as to the category in which we're trading, the UK beauty market is currently valued at 28.4 billion, with a predicted growth of 5% over the next 5 years. So it's a category in the UK that continues to outpace other FMCG categories. That also continues to be the case in a lot of developing and developed nations around the world as well. So it's a very healthy category to be trading in. The UK is the 6th largest personal care category globally, which puts our standing very high considering the size of our population versus some other markets, and a per capita spend that is going to increase quite dramatically. It's predicted to over the next 5 years. This includes products and services in beauty, from £73 a head to £487 a head. So it's a very dynamic market in terms of where people are spending their money. 37% of all global launches were in the UK in 2018, which proves that the UK again, and hence why we're the 6th largest personal care market in the world, is leading innovation in this category. Facial skincare continues to be the biggest category in the UK, with 71% of all UK launches in 2018 being in facial skincare. And that trend is continuing into 2019 and 2020. Just a caveat on the beauty online sales, because this is pre-COVID, and this came from information from a global data report in February of this year. It was predicted that online will grow to 11.6% of the total UK market by 2022. I think we need to wait to see what that data looks like in about 6 to 12 months' time when it starts to be published, because we all know the pandemic has had a tremendous impact on online sales in many categories, and we know that it's had a big impact on beauty. So I think that's probably a very conservative number in terms of how online will grow over the next few years. Still a very female-dominated category, which again is aligned with skincare being the biggest category, 78% saturation versus 41% of males purchasing in the category. Key drivers and buzzwords that you'll now be hearing in this category: treat yourself, aligned with well-being. And again, those two areas of development for our category are increasing even more in light of the pandemic. Sustainability is still very much on the agenda, albeit has slowed down a little bit because of the pandemic, but I would see that accelerating quite considerably again over the next 12 to 24 months. Clean formulas, plant-derived, which you're seeing in the form of vegan claims and veganism coming through into the category, and health and hygiene, which has obviously come onto the agenda in a big way since the pandemic. So in terms of Creightons and the 3 categories that we have, a comparison versus last year and a breakdown of how that is currently looking in our business. Paul has already highlighted the growth areas, but to see how it's broken down in terms of percentage, private label has accelerated from 42% of our total business to 50% of our business for the year ending 2020. Contract manufacturing has taken a bit of a slide, down by 20%, and now represents 28% of our total business, with our owned brands increasing to 22% of our current business with an 18% increase. So a little bit of context on that. So private label is in dynamic growth. It's something that's happened in this category over the past couple of years as the national brands have been fighting on price. There has been a big move back towards private label in the past couple of years. It's a way that the consumer knows that they can achieve value for products as well as quality. But it's also the way that retailers are differentiating themselves against the price fighting that they're doing on national brands. So private label has done very, very well. And as you will see, we've increased our share of private label quite considerably. There has been a slowdown of premium brand demand, even pre-COVID. That has been a key feature, particularly on the high street and within the grocery environment. And that's impacted on our contract manufacturing division and the decline that we saw there, because most of our contract division up until March 2020 has been with premium brands. We also, as Paul highlighted, lost a key customer during the period who purchased their own manufacturing facility. A key feature for us in terms of growing our own brands as well as private label is our continued focus on working with winning retailers globally. So the growth is coming from UK and global markets where we're partnering with leading retailers. As Paul highlighted, during the year, we've almost completely moved away from a distribution model with regard to global market sales. It's not a model that I feel is one that will accelerate growth for us in global markets. We much prefer to work in partnership with leading retailers and direct with those retailers. It gives us more control on understanding that market, and it gives us more control on the growth of that retailer rather than relying on the performance of distributors. So I think changing that model has had a significant impact for us in terms of our global development in key markets. Wanted to give you some insights last year versus this year in terms of how we break down in category performance. And as you will see, our facial skincare category has increased quite significantly in the period. That has been with private label sales, but also the purchase of Balance Active, which is in the main a skincare brand that we started trading during the period. I think the other key point to note in there is body skincare has become a very key category. We moved from about 8.5% of what we did last year in body skincare up to 14.8% this year. And the big growth is coming predominantly from two categories. That is body scrubs and body lotions. This is really quite a new dynamic that's happening in personal care, and I think is aligned with this need for people to focus on wellness and health and hygiene in terms of product formats that they are buying. We've also increased a little bit on gifting. That's an area that we said we've wanted to do more of, and that has increased for us during the period as well, with Christmas programs coming out last year and into early part of this year. So focusing on private label in terms of we're continuing our agenda that we've outlined about 6 months ago, and I wanted to re-highlight that. We play in a multiple category environment within private label with expertises in everything from bath and shower, self-tan, skincare, fine fragrance, baby care, and hair care. So we've had significant growth during the period with key UK retailers and also with some international retail partners. Again, that strategy of working with fewer global markets, but with stronger retail partners and what I call winning retail partners globally is benefiting us not just in terms of our own brands, but once we establish those relationships, we try to move very quickly into the private label opportunities as well. So we've got two key global markets where we're doing as much business on our brands as we are now doing in own label. And I think that's a strategy we want to continue to keep pursuing. It's very healthy for us. We focus continually on margin enhancing and value added categories. So again, skincare, baby care, fine fragrance, and areas where we can add value in the private label category as opposed to competing just on price. We continue to innovate in private label and get speed to market launches. That has been quite an interesting dynamic in terms of what's happened to MPD during the period of COVID, and I'll get back to that in a little bit in terms of the impact with us. And again, we continue to be award-winning in private label in the UK, having again won Supplier of the Year and Service Level Supplier and #1 private label supplier, and continuing to run product towards. In terms of our brands and the brands that we own, just an update in terms of where we are. Key brands like the Curl Company, Bam Beautiful and Feather and Down continue to get extra launches. So for example, Curl has done quite well globally. In fact, our top market is a European market for Curl now, and we've just launched into Saudi Arabia and it's doing very well in both. And very recently in the year launched into Tesco and doing quite well in Tesco, considering it's quite a niche market in hair care. So it's adding value to the Tesco hair care category, which is very positive. Bam Beautiful continues to do very well on TV. We launched it on TVSN in Australia in the period. We continue to trade with TVSN on a regular basis. They said it was the best hair care range that they had ever launched on TV. Traditionally, hair care is quite difficult to do in a market in this distribution channel, but we've done very well in the UK with it and very well with TVSN. We also have opportunities with Germany, France, and the USA that we hope to realise over the next 6 months in TV. Feather and Down continues to do very well. It is a top performing brand for us, our direct-to-consumer brand, as well as doing very well on direct-to-consumer with Boots, which is our key retailer in the UK. And we have a Christmas gift program going into both Sainsbury's and Boots for the brand, which are launching just in a matter of weeks. Balance is the brand that we bought in the period in the skincare category and continues to exceed our expectations. As Paul highlighted, it's a slightly higher retail price than that we do usually at the value end of the market. So it's added nice value to us in terms of what we're doing on brand in the UK. Just wanted to give you an insight as to two brands that we have developed at the very end of the period, literally just before lockdown. So actually these two brands their performance will really be about the next financial year, but I wanted to give you an insight as to what we were working on and we're literally about to launch as we lock down. And the first one is Sanford & Barton of London. We've spent some considerable time exploring the German market and wanting to enter the German market. And the opportunity came in the format of an exclusive brand that a group of stores wanted to develop in Germany. And we launched actually in April of this year, but a lot of activity was happening just as it locked down. And we launched on time. That has now gone into store in Netto, which is part of the Edeka group and is going to extend into the Edeka range of grocery stores in Q4 of 2020. It's a range of bath and body products. It's sitting in the main bath and body fixture. It's fragrance-led, very luxury formulas, but good value pricing. The Made in English heritage is something that these German retailers were looking for, which was very positive. It's got vegan claims, and it's all about natural ingredients. Additionally, we relaunched very, very quickly at the end of March 2020. We moved into Pure Touch, which was a brand that we had dormant. We had actually done some work with it when SARS hit some years ago, but it was not a brand that we continued with. So we had it in our stable of brands and were able to bring it out very quickly and launch that at the end of March. I will talk more about this brand in terms of its future and what we're doing with it when we come and talk to you again at our 6-month review for 2021, because we are relaunching it. It's going to look and feel quite differently. This is how it looked and felt in terms of getting it to market and getting it into the NHS and the opportunities that we got at the end of March and continue to trade during this year. The big thing that I think is probably the most exciting part of this brand is that our technical team worked very quickly on developing a hand cream. We identified that with the additional use of hand washing and gels, which are very drying to the skin and drying to the hands, we really wanted to find a solution that was moisturizing, but would also have bacteria and virus claims. It's taken us some time during that period of lockdown and into early part of this financial year to get all the testing done, particularly the virus testing, because that's quite a long process to go through, but we accelerated that. And the good news is that we managed to get approval on all of that. So you will actually see this product on the market right now in some of the main grocers and some of the main high street stores, but it just has the bacteria claim. The virus claim is coming out this month. Now that we've got the approval on that. And again, we're extending this range, and I'll be able to show you at our 6-month review how this is going to look and feel moving forward. We actually have got a main high street listing for this product already, and a major grocer listing with the virus claims, and we've also got it into 2 international retailers. So I would hope that this is going to be a way that we can differentiate what's happening with Pure Touch and hygiene moving forward. It's an intensely competitive category in gels and hand washes. So what we've been trying to do is find a way to participate with a sustainable model on the brand with products that perhaps are bringing a little bit more differentiation so that we're not just competing on price moving forward with the brand. A key thing for us that has continued to happen through lockdown and into this early part of the financial year is winning awards. And you can see the spread of awards that we've been winning on the brands. The most notable ones for me this year is winning an award for Balance Active on the vitamin C serum, because that was a new purchase. And then we relaunched our ingredients brand into a brand called Body Bliss. That is a brand new launch that launched as lockdown happened. We moved it to vegan claims. We moved it to naturally derived ingredients and sustainably sourced natural ingredients. And the good news is we won a Global Green Award on that just in May of this year, which I think has been a significant one for me in terms of moving that brand forward and giving it claims that are more relevant to what the consumer wants today. So again, I've presented this slide at our last 6-month review. It hasn't changed. These are the drivers for growth that we continue to focus on. For those of you that haven't seen us present before, hopefully this is useful. And it kind of gives the pillars that we focus on moving forward. So continued investment in our sales team. There's 2 things that we are doing and have done. The number one is that we have brought in a new business development manager who has started with us this week, who is going to look after industry and institutions as a channel for us. That is something that obviously we have taken advantage of as the pandemic hit. We believe that there's an opportunity for us to have a more sustainable model in that channel, and we've brought in some expertise to help us on the sales side. The second thing that's happening is we're currently interviewing, which has been delayed slightly because of the pandemic, but as we've picked up in earnest, is we're currently interviewing for a country manager in Germany. As we've opened up the German market, we now have a separate German business there. We have been using a sales agent to help us open the doors there, but our goal is to have our business with our own team over there. So we will be recruiting, hopefully within the very near future, as we're interviewing for a German country manager. Something I've highlighted already is partnering with winning brands and retailers. We're doing that globally. We continue to do that in the UK. And I think that is a solid model for us that we'll continue to take advantage of and pursue moving forward. That has resulted in key account growth. The key thing with key account growth for us is to move into new categories. We have already extended our bar soap category quite considerably. We have won a really nice piece of business with Boots in bar soap that is going to be hitting stores in September. We're manufacturing for them right now. Boots are launching a brand new concept in terms of bar soap, and we were successful in winning that piece of business. So that's been very successful for us. New distribution channels I've already highlighted. TV shopping is continuing for us globally and moving into industry and institutions over the next 12 months. Global market focus with Germany, the Middle East, and the USA being at the top of the agenda. Germany is going well, and we've started well. The Middle East is going very well. The USA for us is a little on hold, just in light of the impact that's happened to their retailers in terms of the pandemic, and their retailers are a lot slower in terms of coming back to market than the UK and Europe. So for us, the USA is something that we're continuing to watch in terms of priorities. So it's dropped slightly in terms of our priority, with Germany taking the #1 priority slot for us. And then ongoing digital development with direct to consumer and continuing to build our brands on social media. The key part there is that we've brought on, again this week, a new head of e-commerce. He comes from quite good pedigree, having built quite significantly a brand online over the past 5 years with quite dynamic growth, and hoping that he is going to bring to us the learnings and what he's done with that brand online in terms of helping us to accelerate what we're doing online direct to the consumer. So finally, I just wanted to do a summary of where I see that we sit from a marketing and sales perspective with what the new normal is. So this isn't really about what's happened in the last financial year. This is what's happening to us right now and how we're driving the business. So there's a number of things that have accelerated as a result of COVID-19. Health and hygiene, well-being and self-care. Skincare as a category is just on fire. It is growing at every single retailer that we trade with. Hair treatments and colorants, the obvious reasons in terms of beauty being shut down on the high street. Direct to consumer, convenience shopping has performed very well during the period. And obviously the consumer behavior with they're going to stores less. If you talk to high street retailers and particularly drugstore retailers, consumers are coming into store less, but they're spending more whilst they're there. So it's really having a strategy to take advantage of that. High street and department stores, as we all know, have declined quite significantly. Global supply chains have been under significant pressure and continue to be under significant pressure. The tail in terms of what the pandemic has done to that is significant. Fine fragrance has nosedived during the period, even online. Fragrance is not being purchased by consumers right now. If you think about people being at home and going out less, it's just not a category that they're buying. Color cosmetics has gone down, as has male grooming. For some reason, men just stopped washing and bathing and stopped shaving. So male grooming sales have gone down considerably. And big brand NPD declined during the period. I believe that will come back, and it will probably come back in some force, but during the period, end of March and through to where we are now, big brand NPD has definitely declined. So for me, where we position ourselves is now very important to take advantage of the benefits of what is increasing as a result of the new normal. So the brand consumer relationship is changing quite dramatically. And I think for us, that model of working direct with key winning retailers is also about having that relationship direct with the consumer and understanding with immediacy what the consumer is buying and understanding what the consumer wants. So obviously our relationship, not only with direct to retail, but direct to consumer is very important. And I think we're very well placed in terms of how we position ourselves there. Agility without a doubt wins. We, I think, are demonstrating currently that we're very agile in terms of the types of products that we can do and where we do it. And that will be a key theme for us moving forward. We need to stay agile in order to take advantage of what's moving so quickly. Value performance products are definitely performing well. So whilst we say that the high street has definitely had some losers, there have definitely been some winners on the high street as well, particularly with regard to some key discounters. The consumer is looking for value performance products, as they always have. And I think much like what we did in 2008, and we repositioned some of our brands in the value space, we are definitely seeing value performance products doing very well. So for example, hair care for a small period of time during the lockdown definitely declined, but we're seeing haircare sales return back to normal, definitely within our value positioned performance products. And again, providing solutions. As you know, I define us as a solution provider, not just as a manufacturer. And we have worked very, very closely with retailers during this lockdown period to make sure that we're providing solutions at every single level. So that has not just been about continuing with MPD. So we've continued to keep the MPD tail moving through the whole process, but working with key retailers during the period on supply chain, for example, and focus on products that sell. So in some cases, we've switched off products that perhaps are slower sellers, and we've worked with key retailers on double, triple facing, on merchandising solutions on products that sell very well, so that we can ensure that we're putting products on shelf that consumers want to buy. So again, providing solutions at every single level, whether that be MPD, supply chain, working very closely with direct to consumer and understanding what the consumer wants, is where we're positioning ourselves. So I'm now going to hand you back to Bernard for his conclusion.
Thank you very much, Pippa and Paul. I will give you our aspirations for the future. Start off by recognizing that we've got loads of challenges with Brexit, with COVID, and with a weakening UK high street. We are good at taking advantage in disadvantaged situations. So our vision is still the same as in previous years. We will close out the current 2021 fairly successfully, I think. We're aiming and aspiring to 55 million plus, net profit after tax of 7%, a rate of return on capital of 20%, and a dividend of 2%, which is reasonable. It's an aspiration. There are a lot of risks, but I think we've got the team and the ability to do it, provided that nothing we can't handle crops up. We don't see anything at all that we can't manage to control or get in front of. Our stall for 2025, I've moved it up from 2024 in the previous year. We want to continue this momentum because we find as we move up every 10 million, we get a better percentage on the bottom line. It's not cutting edge management, but it's just, it's what we do and what we find increases our net profit. So we expect to be at 9% by the end of 2025 with a rate of return on capital of 20%, keeping that pretty much down because the more cash we generate, unless we find somewhere good to put it, it reduces our rate of return. And we want to keep our dividend at 2%, at least 2%. We continue to grow our UK customers. We're doing very well with the customers we have. Every single one of them expands each year. We work the export markets, as Pippa has said, direct to retail in Germany, Middle East, and the USA. Eventually, we're a bit quiet there at the moment, but we will get back in there again as soon as the opportunity presents itself. We're extending the contract business. We want to focus on that this year, as Pippa has said. We continue with our product development and competitive prices to meet what we see as a possible prolonged recession. I think Pippa's touched on it very well and explained it very well. We're back to our 2008 position where high quality at good value will sell at the right price point, and I think we can do it in every single aspect of our business. We want to. I think there might be opportunities in the near future to purchase brands, particularly in skincare and well-being. We want to spread that between premium and mass. We feel there's a position for us in each of those areas. And we'd very much like to recognize the future being on the web by buying a web-based retailer in health and beauty. So those are our main aspirations. It's really more of the same. It's really boring for you. But if we can hit 100 million and do that profitability, I hope you'll be satisfied as shareholders. Just to end this little piece, Mary Carney, one of our directors, passed away, and we'd like to pay tribute to her. Mary was one of our longest serving directors, and she passed away during the last financial year. She was part of the team that rescued Creightons PLC way back in 1999 and the year 2000 via a rights issue. And at that time, she did a lot of hard yards in terms of rescuing the company and making sure any money raised in that rights issue was properly spent and controlled. She signed every check, looked at every purchase order, was very clear in her decision making, and eventually became a very effective non-executive director who very much helped me in every aspect. So I will miss her, and we will all miss her, and we intend to replace her very soon. So thanks very much, Mary. So we will now turn it over to any questions you might have. We can't see your faces, but we can certainly take your questions and hopefully answer them well.
So we have a question from James Nelson, who says, you have previously considered acquisitions, but have not made a large acquisition in recent years. Are you still looking at larger acquisition opportunities of, say, 5 million plus?
Yes, 5 million plus would sound good to us. We just haven't had the right opportunity at the right price. We've looked at several opportunities, but we've been outbid, I suppose, in the final situation. And I think that's, we're not going to spend our money unless we feel we're getting value on it. And that's basically what we're all about. So we're in business to make an acquisition, particularly in skincare, if one came along at 5 million, possibly even 10 million.
And Bruce Packard asks, I noticed inventory was down year on year while sales were up, despite customers cancelling orders. Just wondered what happened there.
Paul will probably come in on this, but really the customers cancelled orders in the middle of March. It didn't really have any effect on the ratio, in the sense that by the end of March, there was only 2 weeks. It had a different effect by the end of April and May in terms of balance sheet. So that we really were managing stock a lot better and moving towards lean manufacturing, more effective lean manufacturing, etc. But the real impact of the cancellations and the COVID effect didn't come through until April, May, and June. Paul, would you like to say something on that?
Yes, and we have a continued drive to try and reduce inventory. Some of the more common items, the raw materials, do turn more quickly as we grow the business. So we replenish more quickly. So there has been a target to reduce that. As Bernard said, we switched the production over the 3 months or so post-COVID. And that did leave us with an inventory investment that stuck because the customers had delayed or cancelled orders, whilst we replenished and repositioned and bought more bottles and tubes and etc. to deal with the hygiene-related and products that were going on in the market. So there has been an increase in inventory since the year end, but also a significant increase in there has been also a significant increase in the sales of these products that have compensated. Cash has our working capital requirements gone up since the year end as a result of that. But equally, if we analyse that, the majority of that at the moment is in debtors, which will come through in the future. So we are seeing a positive switch, an increase in the inventory, but also as we go through the year and the customers are now taking stock again, we'll see that coming back later on in the year. So overall, we're anticipating inventories to still come back down and be aligned with the level of sales, if that answers the question. Yeah.
And Brian Geary asks, for the no-fault customer loss of the online retailer, what was the monthly revenue impact?
That was a loss of 3 million annually. So if you look at the results to the end of March in terms of the growth that we did achieve, that was still achieved in the context of losing a £3 million account.
And the next question from Sam Morland asks, in the past, you have expressed your aim to sell significant amounts online. I know you've made some mention of it, but it's been more in passing. With COVID, is there not even more need to sell online?
That's a fair point. There will be, I think there are opportunities, and with COVID, there are even more opportunities. We just have to extend our product line. We've got to extend our organization. I was more keen to buy a web-based company or a digital company. One hasn't come along at the right price, but we are putting resources now into improving our online sales.
And Randy Gruel asks, can you discuss what you're doing for the NHS/Department of Health? Is this a long-term business opportunity or simply short-term? And are the margins similar to the rest of the group?
Pippa, would you
Okay,
like to...
I'm happy to answer that. So when lockdown happened, the NHS reached out and were looking for additional suppliers on PPE and hygiene products. We got ourselves into that opportunity. It was quite a significant and rigorous process we had to go through at a very, very short period of time. And what they've done is they've issued 6-month contracts. It's been a nice, significant contract for us. It will extend through to, originally extended through to October, but it's been extended through to the end of January because the NHS have got logistics issues in getting the product through their system. We are now looking at the opportunities in the wider healthcare market to have a more sustainable model within healthcare. So yes, they are one-off contracts that have been issued. Whether or not the NHS will extend those, they are talking about going back to their regular tendering process, which is a very long and involved process. But that's to supply hospitals. There are other opportunities within the healthcare sector that aren't necessarily direct to hospitals and direct to the NHS and the Department of Health. We've learned a lot in terms of social care, care homes, and other frontline services, hence why we're bringing on a business development manager that can start to explore those opportunities. So I guess the concern for me with the NHS tendering process is the period of time that it takes. And I think there are better opportunities that will perhaps realise quicker for us by splitting out how healthcare is being delivered in the UK market.
And Randeep also asks, given your hiring and your existing retail online website, do you have specific ambitions for this as opposed to an acquired web business?
We have our ambition is to drive that to 4 million inside the next 2 or 3 years. That's the target given to our new recruit. That, you know, we've been successful in all other areas of our business. We feel we can do it, but we feel we're very much dependent on this new recruit to set out their stall and make sure it's done. There's not a lot more I can say on that at the moment. We have got a basic product line. We feel that we should add to that product. It's about what you offer on the web, and we have our own brands. We don't extend outside our own brands. We may do that. Maybe Pippa would like to say a few words on that, but there's not a lot more I can say.
Yeah, I mean, just to support what Bernard's saying, obviously we've got some great brands. We do very well in bricks and mortar with them. They are increasing, but from a portfolio for brands on an internet retail platform, it's very limited. So for us, you know, a big step forward on digital sales is going to be either launching more of our own products, which takes time, or it's going to be, you know, establishing partnerships with other brands and putting them onto our platform. So it's a completely different model in terms of being able to advance that. Some of our products do quite well for us online, but as I said, it's a limited portfolio that we have. You know, we have a portfolio that matches bricks and mortar, not a portfolio that necessarily manages the extent that digital online providers want to see. And I think that will be a key target for our new recruit in terms of how we start to tackle that and what additional resources we need in business to really set out a more comprehensive and broader product portfolio online. I guess that would be my contribution to that.
Yeah, thanks. It's a very challenging situation for us. We would have been more bullish 2 years ago, last year, but we found that there are things that need to be done, and you can actually sell more on Amazon than you can on your own website, and just be price competitive. We want to increase the range of products we offer, We want to be profitable in what we offer. We want to give the consumer. So a lot of it will be about well-being. We'd like to move more into the well-being area with a particular niche on the web.
And Brian Geary asks, the operating margin increase was significant. Clearly it's transient period, but how do you see the underlying margin in future? Is it a sustainable function of the change in mix and up-marketing?
Yeah, it's all of those things, and also an increase in the volume. Hence our aim to continue the momentum and continue an increase by at least 10% per year. Yeah, we are moving up the margin ladder. We're reducing the overheads. We're becoming more efficient. Size also allows you to be more efficient and more productive with the machinery you have. We want to invest in higher speed and more efficient machinery, reduce the manpower. In fact, be able to do twice as much in the same footprint with the same number of people. Ultimately, it's not, you can't achieve that absolutely, but it will be possible, I think, to achieve that 10% on the bottom line if we have 100 million turnover, and if we do that in 3 years, great.
And Bruce Packard asks, where was the rent for the building in the P&L recorded? If the cost is now below the operating profit, brackets finance cost, then that flatters operating profit growth trend.
Paul, will you take that one?
The answer is it was. The comparable figure, the rent was in the overhead line at 350,000 in a full year equivalent in those figures. And of course, we've got the interest cost of the mortgage below the line, so it does flatter. It does, it is not directly comparable in the two figures. That's the answer there.
And Sam Morland asks, when are you expecting to produce the H1 21 results?
Paul, would you like to take that one?
Yeah, we're expecting to produce those in the same timeline as previous years. So it would be by the end of November, we'll be announcing those results. So it'd be typically a third or fourth week in November we would need to release them.
Hank Verman asks, would you consider repurchasing shares in order to offset share account dilution as a result of operating option grants?
There is a dilution in the earnings per share as a result of obviously the exercising of options. That has helped motivate employee management, and shareholder value has increased by quite significantly as a result of that. We have the facility within the approvals at the board meeting to take up the purchase of shares should we want to, but at the moment we feel as though there's probably more opportunity to grow shareholder value by looking at potential acquisitions at the so it's not something we're actively considering, albeit it is an option available to the board.
And Robert Sanders asks, how much furlough cash have you used, and are you considering repaying this cash as some other companies have done recently?
We've used a lot of cash in terms of putting people out on whatever you call it, on furlough, on self-isolation, on vulnerability. I think we've got about 138,000 back from the government in terms of that. We don't intend to repay it unless somebody finds a good reason why we should. But the 138,000 was for people who had to be furloughed, couldn't work, were vulnerable, and that's what the government offered, and that's what we've taken up. Paul, is there anything else I should say there?
No, as soon as most of that was in the early part when we had cancelled orders and didn't have new orders on place. As the business activity picked up, everyone is now off furlough. All employees are back in the business, so we're not taking advantage of any of those schemes at the moment.
And a question from Leo Hendry. Please could you outline your likely organic capex over the next couple of years?
Good question. We have two two paths here. One is for extending the building where we are short of warehousing capacity and could possibly bring back in-house our third-party picking and packing. We haven't made that final decision yet whether to invest or not to invest. But in terms of machinery and increasing our efficiency, which is we see as a different subject, it's kind of working capital. We would probably spend 1.5 million in the next 18 months.
And Brian Geary asks, can you say something about the staff measures during the virus peak and how things are now? Is there a current impact on cost and productivity?
Yeah, Paul will probably give you more detail on this, but there's a huge impact for us. Some benefits in terms of people working from home and not needing as much office space, but in terms of the increased cost of security, of setting up lab testing, of making sure people are safe, of increased working areas to accommodate social distancing have been very significant. In fact, we've probably spent, between paying people extra money to come into the factory and bonuses of different incentives of different kinds, isolation costs, we probably spent 600,000 or 700,000, which has been to some extent recovered by the increased sales, for example, to the NHS. But we're talking about current year, and we're not really in a position to be more exact than that about the current year. Paul, would you like to say something on that?
Yes, I mean, a lot of those costs were very early on and they're now down to a lower level, but we are keeping our site secure. We've got increased checking on everyone coming on site, testing of all people. We do isolate and we do our own track and trace when we do find instances within the factory. What we do not want to do is end up in a case where we end up with an outbreak within our facility, and we've got lots of measures in place, including managing employees' travel to work and home from work, so that there's less, or limiting the amount of car sharing as far as possible. So we have done a lot to try and mitigate the risk. It hasn't come without a cost, but it is the right thing for the group for the long term, and it is it has enabled us to take advantage of the opportunities that have come our way. So we feel as though it's although it's still ongoing, it is manageable for the group in the current position, the current state we're in.
Do you want to comment a little bit on the corporate vehicle you've been using in order to transport staff?
Yes, we bought a bus.
A double-decker
Set
bus.
up our own bus route.
Green double-decker bus.
A green double-decker bus.
Yeah.
The comedian as a
Which
driver.
is totally controlled by us, and people have social distancing, and we have a bus route that brings employees to and from work.
Yeah.
And David Butterworth says, this is a comment rather than a question. Thank you all for what you have done to steer the ship through these difficult COVID times. I'm sure all shareholders are grateful. Please keep up the good work. And with that, Bernard, would you like to say some closing remarks?
Well, I would just like to thank everybody for listening to us, for participating. They've shares in our company. We are delighted that they have shares. We do our best for them. We love that comment you've just made. And thank you to everybody for helping us so much. We love this job. We love doing what we do. Hopefully we'll continue to be successful. And thank you. Thanks, Pippa, and thanks, Paul, as well, for the presentation.